Chapter 1. The Power of Debt, Friend or Foe. Imagine for a moment that debt isn't the enemy you've always been told it is. Instead, envision it as a powerful tool, an instrument that, when wielded with precision and insight, can propel you toward a future of lasting wealth. In this chapter, we're going to peel back the layers of common misconceptions about debt and reveal how it can actually serve as a strategic ally in building multi-generational wealth. For many, the word debt evokes feelings of anxiety and defeat, a reminder of past mistakes or looming financial burdens. But let's reframe that perspective. Debt, in its most refined form, is simply capital you're borrowing to create opportunities. It's a lever that can multiply your financial potential if used wisely. Consider it akin to a powerful engine in a car. It can either drive you forward at breakneck speed or, if mismanaged, spin out of control. The key lies in understanding how to harness this engine for growth, rather than allowing it to become a heavy anchor. Take, for example, the story of Ryan, a composite character representing many of us who once struggled under the weight of financial obligations. Ryan grew up hearing that debt was something to be avoided at all costs. Yet, in his early 30s, with a modest income and a desire to break free from a stagnant financial situation, he made a bold decision. Instead of steering clear of borrowing, Ryan chose to leverage a low-interest loan to invest in a small, undervalued property in an up-and-coming neighborhood. Many doubted him, warning that he was flirting with danger. But Ryan's calculated risk paid off. As property values climbed and his rental income steadily increased, he not only repaid his loan, but also built a foundation for future investments. His story is a vivid reminder that when approached with caution and knowledge, debt can transform from a paralyzing liability into a dynamic tool for wealth creation. This isn't just about taking risks blindly. It's about understanding the mechanics of debt and aligning them with your long-term financial goals. At its core, debt is a way to access capital that you don't currently possess, allowing you to invest in opportunities that might otherwise be out of reach. Whether it's buying real estate, starting a business, or investing in education, borrowing wisely can open doors that lead to exponential growth. The trick is to distinguish between what we call good debt and bad debt. Good debt is an investment, an outlay that, over time, generates returns far exceeding its cost. Bad debt, on the other hand, drains resources without adding value, such as high-interest credit card balances used to finance unnecessary expenditures. The transformation in perception begins with education. Once you comprehend that not all debt is created equal, you can start to see its potential as a strategic asset. Think of it like learning a new language. At first, it might seem foreign and intimidating, but as you become more fluent, you begin to see its nuances and possibilities. In the realm of finance, that fluency translates into the ability to evaluate risks, compare interest rates, and calculate potential returns. With this skill set, you begin to view debt not as a chain that binds you, but as a tool that can help you break through the limitations of your current financial situation. Let's delve deeper into the numbers behind this concept. Suppose you secure a loan at a low interest rate, and you use it to purchase an asset that appreciates in value over time. Even if your initial outlay is small, the power of compounding can turn that investment into a substantial asset. It's like planting a seed that grows into a mighty oak. Every payment you make isn't just reducing what you owe, it's also an investment in your future, a step toward a legacy that can be passed down to your children and grandchildren. This is the essence of multi-generational wealth, building something that transcends your own lifetime. Of course, with great power comes great responsibility. One of the most critical aspects of using debt as a tool is risk management. You must always ensure that your debt levels remain manageable and that your investments generate sufficient returns to cover the cost of borrowing. This involves thorough research, planning, and sometimes the willingness to walk away from a deal that doesn't add up. It's about being honest with yourself, acknowledging that while opportunities abound, not every venture is worth the risk. A disciplined approach to debt can prevent it from spiraling out of control, transforming it into a steady engine that drives your financial progress. Let's revisit Ryan's journey to illustrate this point further. When he decided to invest in that modest property, he didn't leap in blindly. Ryan meticulously analyzed the market, evaluated the potential risks, and crafted a repayment plan that ensured he could handle any unforeseen financial hiccups. His strategy wasn't about taking a gamble. It was about calculated risk-taking. By doing so, he not only secured a steady stream of rental income, but also set himself up for future growth. His experience demonstrates that the power of debt isn't in the borrowing itself, but in the informed decisions that guide its use. As we explore this concept, it's crucial to acknowledge that the conversation around debt is often steeped in emotion. For many, it's a source of shame or regret, a relic of past financial missteps. But here's the truth. Every successful investor has, at some point, had to navigate the treacherous waters of debt. The difference lies in the approach. Rather than shunning debt outright, the savvy investor embraces it as a means to an end. This shift in mindset, from viewing debt as a curse to seeing it as a strategic asset, is what separates those who stagnate from those who soar. In this journey of financial transformation, knowledge is your most valuable asset. By educating yourself on the various forms of debt, understanding how interest works, and learning to evaluate the true cost of borrowing, you empower yourself to make choices that align with your long-term vision. Debt, when used intelligently, becomes not just a temporary boost, but a stepping stone toward financial freedom. It allows you to bridge the gap between where you are today and where you want to be tomorrow, creating a ripple effect that can benefit not just you, but future generations. In summary, the power of debt lies in its potential to be harnessed as a tool for growth rather than a source of despair. It is neither inherently good nor bad. It is neutral until you assign it a purpose. By shifting your perspective and arming yourself with the right knowledge, you can transform debt into a formidable ally in your quest for multi-generational wealth. Embrace the journey, learn from each step, and remember that every smart financial decision you make today is an investment in the future of your family. Let this be your first step toward a legacy that defies the conventional wisdom of debt as merely a burden, and instead celebrates it as a catalyst for enduring prosperity. Chapter 2. Laying the Foundation for Multi-Generational Wealth. Imagine you're at the starting line of a long race, where every decision you make now impacts not just your future, but that of your children and grandchildren. Laying the foundation for multi-generational wealth isn't about overnight riches. It's about building a resilient financial base, one that turns everyday decisions into stepping stones towards lasting prosperity. Today, I'll walk you through concrete, actionable steps that can transform your relationship with debt and set you on a course for generational success. Let's begin with a core pillar, a rock-solid budget. Creating a budget isn't simply about listing expenses. It's about understanding your cash flow on a deep level. Take, for instance, the story of Jack. In his early 30s, Jack found himself struggling with sporadic income and mounting bills. Instead of being overwhelmed, he sat down with a notebook and created a detailed monthly cash flow chart. He noted every expense, from the obvious rent and utilities to the smaller costs like subscriptions and even the occasional coffee out. By tracking every penny, Jack discovered a hidden truth. There were unnecessary expenses he never even considered wasteful until he saw them in black and white. He cut back on non-essential spending and redirected that money into an emergency fund and debt repayment. His budget became a blueprint for every financial decision thereafter. Now, actionable tip number 1. Record every expense for at least 3 months. Use a simple spreadsheet or budgeting app. The goal is not to restrict yourself, but to have a clear picture of where your money is going. This clarity allows you to make informed decisions about where you can cut back and how much you can realistically allocate toward debt reduction and investment opportunities. Once you've established your budget, the next step is to understand and manage your credit. Credit isn't just a number. It's your passport to better interest rates and larger loans when you need them. Consider the case of Sarah, a composite figure who, like many, saw her credit score as a distant number she had little control over. Sarah began by requesting free credit reports from all 3 major agencies. She combed through each report, identifying errors and outdated information that was dragging her score down. With a clear plan in hand, she paid off small balances and negotiated with creditors for better terms. Over time, her score improved significantly, which not only reduced the interest rates on her existing loans, but also allowed her to qualify for a low-interest home equity line of credit, a tool that later became instrumental in her wealth-building journey. Actionable tip number 2, check your credit reports regularly. Dispute any errors, pay down small debts to reduce your credit utilization ratio, and always pay bills on time. These steps will gradually boost your credit score, giving you the leverage you need when it comes time to borrow strategically. But a strong budget and a healthy credit score are just the beginning. To truly lay a foundation for multi-generational wealth, you need to plan for both the expected and the unexpected. This means building an emergency fund. Picture a scenario where you're forced to cover a sudden medical bill or a critical car repair. Without a safety net, you might be forced to take on high-interest debt, derailing all the progress you've made. Jack, our earlier example, dedicated at least 3 to 6 months' worth of living expenses into a high-yield savings account. He did this not because he loved saving, but because he knew that any disruption could jeopardize his journey to wealth. Actionable tip number 3, build an emergency fund that covers at least 3 to 6 months of expenses. Automate a monthly transfer into this fund right after you receive your paycheck. Treat it as a non-negotiable expense. After all, this fund is your financial shock absorber. With a budget, solid credit, and an emergency fund in place, the next step is leveraging debt responsibly to build assets. Here, it's essential to shift your mindset. Debt is not inherently evil. It can be a tool for acquiring appreciating assets. Consider using low-interest loans to invest in income-generating assets like rental properties or small business opportunities. For example, Michael, a composite story drawn from real-life principles, took out a modest loan to purchase a small duplex in an up-and-coming neighborhood. Instead of waiting until he had saved 100% of the purchase price, Michael used the loan to secure the property and immediately began renting out units. The rental income covered the loan repayments, and as property values increased, he refinanced to pull out equity and reinvest in another property. Michael's strategy was calculated and measured, proving that when you borrow within your means and invest wisely, debt becomes a stepping stone rather than a stumbling block. Actionable tip number 4. When considering a debt-financed investment, always ensure that the asset generates income or appreciates reliably. Do your due diligence. Study market trends, assess risk, and plan for the long term. Consult with financial advisors or experienced investors if needed, and never invest in something you don't fully understand. It's also important to monitor your progress and adjust your strategies over time. Use financial milestones as checkpoints. For instance, set a goal to improve your credit score by a certain number within a year, or aim to pay off a specific portion of your debt within 6 months. Celebrate these achievements. They are proof that your efforts are paying off. Reflect on your progress quarterly and adjust your budget, spending, and investment strategies accordingly. Actionable tip number 5. Set measurable financial goals and review them regularly. Create milestones that are specific and time-bound, like reduce my debt by 20% in 12 months, or increase my savings rate by 5% over the next quarter. These targets keep you motivated and help you track progress. Laying a foundation for multi-generational wealth is not an abstract ideal. It's about taking real, everyday actions that compound over time. Start with the basics. Understand your cash flow. Nurture your credit, build an emergency fund, and then leverage debt to build assets. Each step reinforces the next, creating a virtuous cycle of financial empowerment. Remember, this isn't a sprint, but a marathon. Consistency, discipline, and informed decision-making are the keys to ensuring that your financial legacy endures for generations. As you walk this path, keep in mind that every dollar saved, every debt managed, and every strategic investment builds not just your wealth, but also a legacy of financial wisdom for those who follow in your footsteps. The journey may seem daunting at first, but with a clear plan and relentless execution, you can turn your financial foundation into a fortress of multi-generational prosperity. Now, take a deep breath, get your pen and paper, and start laying the foundation today, because the decisions you make right now will echo in the financial well-being of your family for years to come. Chapter 3. using debt as a lever, real-world examples. Let's talk about something no one ever teaches you in school: how to use debt to your advantage. We've all heard the horror stories: people drowning in loans, crushed by credit card interest, living paycheck to paycheck. But here's the thing: debt isn't the enemy. Used strategically, it's one of the most powerful wealth-building tools at your disposal. The right kind of debt. Before we get into real-world examples, let's get one thing straight. There's good debt and bad debt. Bad debt? That's maxing out your credit card on things that won't put money back in your pocket. Expensive vacations, the latest gadgets, a car you can't afford. Good debt? That's money borrowed at a low cost that allows you to acquire something that will increase in value or generate income. Real estate, education, in certain cases, business investments. These are classic examples of good debt when used wisely. The goal isn't to avoid debt altogether. It's to make sure that every dollar borrowed is working for you, not against you. Case study number 1, the house hack. Meet James. At 28, he was making $60,000 a year working in tech, but he was frustrated watching his rent eat up a third of his paycheck. He didn't have enough saved to buy a house outright, but he had good credit and stable income, 2 things that banks love. Instead of waiting years to save up a 20% down payment, he leveraged an FHA loan, which required only 3.5% down. He bought a modest duplex for $300,000. His mortgage, including taxes and insurance, came out to about $2,000 a month. Here's where it gets interesting. He rented out the other unit for $1,800. Suddenly, his housing costs dropped to just $200 a month. Within 2 years, the property appreciated to $350,000. He refinanced, pulled out $30,000 in equity, and put it toward another property. By the time he turned 35, James had 5 rental properties, all paying for themselves. His tenants were effectively buying his properties for him. This is what we mean by using debt as leverage. Habibi, case study number 2, buying a business with other people's money. Debt isn't just for real estate. Let's talk about Nate, a guy who had been working as a manager at a landscaping company for a decade. He knew the business inside and out, but he was tired of making money for someone else. He wanted to buy his own company, but didn't have the capital. Instead of giving up, Nate found a landscaping business for sale where the owner was retiring. The price? $500,000. He didn't have anywhere near that amount saved. But he did have something just as valuable: knowledge and experience. He negotiated a deal where he put down $50,000 of his own savings, got a $250,000 small business loan, and convinced the seller to finance the remaining $200,000 over 5 years. This meant he only needed to come up with 10% up front. The business was already generating $150,000 a year in profit. After making his loan payments, Nate was still clearing $80,000 annually, more than he had ever made working for someone else. Within 5 years, he had paid off the seller-financed portion, and by year 7, he fully owned a company worth over $1 million. This is how you buy a business without being rich. Smart debt, structured properly, can put you in the owner's seat faster than saving for decades ever could. Case study number 3. Leveraging debt to scale investments. Real estate and business ownership are great, but what if you just want to grow your stock portfolio? Enter Rachel, a savvy investor who understood the power of margin loans. Rachel had been investing in the stock market for years and had built up a portfolio worth $100,000. Instead of waiting to save more money, she opened a margin account, which allowed her to borrow against her stocks. She took out a $50,000 loan at a low interest rate and invested it in blue-chip dividend stocks that historically averaged 8 to 10% returns. The key? She only borrowed what she could afford to cover if the market dipped. Over the next 5 years, her leveraged portfolio grew significantly. By the time she hit 40, she had amassed over $500,000 in investments. The borrowed money wasn't a liability. It was a tool that fast-tracked her wealth. The rule of smart borrowing. If you take away one thing from this chapter, let it be this: never borrow money unless it's going to make you more money. Low interest beats high interest. Borrow only when the cost of debt is lower than the returns you expect to make. Cash flow is king. If debt payments are eating up all your profits, you're over-leveraged. Always have a backup plan. Market downturns happen. Recessions happen. Plan for the worst-case scenario before taking on any debt. Debt isn't the villain of the story. Used wisely, it's the hero that gets you to financial independence faster. Chapter 4, Strategic Borrowing, Debt as a Tool for Growth. Welcome to Chapter 4. Let's get straight into it. In this chapter, we're breaking down exactly how to use debt not as a burden, but as a launch pad for growth. This isn't abstract theory. This is real, actionable advice drawn from real-life experiences. Picture this. A guy named Mike, a 42-year-old family man from Ohio who turned a cautious $25,000 loan into a stepping stone for building his investment portfolio. Mike's journey isn't a fairy tale. It's a blueprint you can follow if you're willing to get disciplined and strategic with your borrowing. The first actionable tip is simple. Know your numbers inside and out. Before you even consider borrowing, take a hard look at your financial health. Check your credit score, assess your current debts, and calculate your debt-to-income ratio. Mike started by pulling his credit report, discovering that a few late payments had dragged his score down to 630. He wasn't proud of it, but he knew that his credit score would determine the interest rate on any loan he took. Over the next 6 months, he paid down high-interest credit card debt, negotiated better payment terms, and even set up automatic payments to avoid slipping up again. His efforts raised his score to 700, which saved him thousands in interest over the life of his loan. Next, shop around for the best terms. It's not enough to just secure a loan. You need a loan that works for your strategy. Mike spent time comparing rates from different lenders. He learned that a difference of just half a percentage point on a $25,000 loan could mean over $1,000 in additional interest over 5 years. So he didn't settle for the first offer he received. Instead, he negotiated and leveraged multiple quotes to secure a loan at a 3.2% annual rate. That low rate was his secret weapon. It kept his monthly payments manageable and left more room for reinvestment. Now, let's talk about using debt to buy income-generating assets. This is where strategic borrowing transforms into wealth building. Mike had his eyes set on a modest rental property in a growing suburb. He did his homework, researched neighborhood trends, compared property values, and calculated potential rental income. With his loan in hand, he purchased a small duplex for $150,000. Out of pocket, he needed a down payment of $30,000, a sum he had been saving diligently. But the magic happened when the monthly rental income not only covered his mortgage, but also contributed an extra $200 to his savings account. In this case, borrowing wasn't just about buying a house. It was about acquiring an asset that put money back in his pocket each month. For those of you listening, here's a direct takeaway. Always focus on cash flow. When evaluating an investment, ask yourself, will the income from this asset cover the cost of the loan and then some? This simple calculation can be the difference between a debt burden and a revenue stream. Mike's duplex generated a positive cash flow, which meant he wasn't stretching his finances thin. Instead, he was building a foundation for future investments. Another critical point is to use debt as a tool for leverage, not as a crutch for overextension. Debt can be a powerful accelerator if you keep your overall risk in check. Mike adhered to a rule he set for himself: never borrow more than 30% of his total net worth for investment purposes. That way, if the market took a downturn or unexpected expenses cropped up, he wouldn't be left scrambling. This rule isn't just arbitrary, it's a shield against the all-too-common pitfall of over-leveraging, which has ruined more than its fair share of financial dreams. Let's also address a common pain point: the fear of taking on debt. Many of us were taught to avoid debt at all costs, but here's the reality. Not all debt is bad. When used properly, it's a tool that can accelerate your wealth-building journey. Instead of shying away, face the numbers head-on. Write down your monthly income, expenses, and potential investment returns. Create a realistic plan. Mike, for example, sat down with a notepad, broke down his projected rental income, mortgage payments, and maintenance costs, and then built a cash flow model. When he saw the numbers clearly laid out, the risk became manageable and the opportunity unmistakable. Now, here's an actionable strategy. Consider starting small with a pilot project. Don't jump into a massive investment that puts your financial stability at risk. Instead, use a smaller loan to test your strategy. Mike's initial duplex was his pilot. Once he proved that the model worked, he reinvested the additional cash flow into a larger property portfolio. This incremental approach not only minimizes risk, but also builds your confidence as you watch real results unfold. One more key piece of advice. Always have a contingency plan. Life throws curveballs, and the best investors are prepared. Set aside an emergency fund that covers at least 3 to 6 months of your mortgage and maintenance expenses. Mike's prudent approach involved keeping a reserve fund specifically earmarked for unforeseen repairs or gaps in rental income. This safety net ensured that even if a tenant vacated unexpectedly or an expensive repair came up, he wasn't forced to scramble for cash or take on additional high-interest debt. Finally, document your journey and learn from each step. Every investment is a lesson in strategy, risk management, and timing. Keep detailed records of your transactions, cash flows, and even mistakes. Over time, you'll notice patterns and areas for improvement. Mike maintained a simple spreadsheet that tracked every dollar. Over time, he noticed that properties in areas with a 5% annual population growth yielded 15% higher rental income than those in stagnant regions. This insight informed his next property purchase decision, enabling him to avoid common pitfalls and make smarter investments. In conclusion, strategic borrowing isn't about taking reckless gambles. It's about making informed decisions. It's about understanding that every loan comes with numbers you can control. It's about knowing your credit, shopping for the best terms, and investing in income-generating assets that provide real, tangible returns. Mike's story is proof that with careful planning and disciplined execution, debt can be transformed from a weight that holds you down into a tool that propels you forward. So, take a deep breath, grab your notepad, and start analyzing your financial picture today. Set your rules, test the waters with a pilot project, and build that contingency fund. The journey might seem daunting, but remember, every great legacy starts with a single, well-planned step. And that step could be the moment you decide to take control of your financial future with strategic borrowing as your ally. This is your roadmap. Embrace the strategy, follow the plan, and let debt work for you, not against you. Welcome to Chapter 5, Risk Management and Mitigation. Now, let's get into the nitty-gritty. If you're serious about using debt as a tool for building generational wealth, you can't afford to treat risk like a roll of the dice. Today, I'm going to give you concrete, actionable steps that will help you dodge common pitfalls and keep your financial strategy on track, even when life throws you a curveball. Let's start with a story. A few years ago, I met a guy named Dave, a 42-year-old father of 2 who had been steadily climbing the ladder of investments. Dave was smart, but like many of us, he had moments when the numbers didn't line up. He had taken on a few debt obligations to buy a rental property and to invest in his small business. But then, an unexpected downturn in the local market threatened his cash flow. Instead of panicking, Dave had prepared for just this kind of scenario. He had built a rainy day fund equivalent to 3 months of all his fixed expenses. When his rental income dipped, he was able to cover the shortfall without scrambling for extra cash or taking on more high-interest debt. Now, let me break down the exact steps that Dave and others like him have taken to manage risk effectively. 1. Know your numbers inside and out. You need to track every dollar. Create a detailed monthly budget that includes not just your income and fixed expenses, but also the variable costs that often catch you off guard. For instance, if you've taken on debt for a property, include maintenance, unexpected repairs, and periods of vacancy. Use tools like spreadsheets or budgeting apps. Dave used a simple Excel sheet to monitor his cash flow and review it every month. This isn't just about bookkeeping. It's about understanding your financial position in real time. If you see a red flag early, you can adjust before the situation worsens. 2. Build an emergency fund and then some. A good rule of thumb is to have an emergency fund that covers at least 3 to 6 months of your fixed expenses. But let's be real, if you're leveraging debt, you need more cushion. Aim for 6 months at a minimum, and if possible, try to stretch that to 9 months. I recall another case, a young investor, Mark, who had taken on a significant debt load to buy his first investment property. When the property market softened unexpectedly, he had enough saved to cover not only his mortgage payments, but also the extra costs of a minor renovation that became necessary. The lesson? Don't skimp on your emergency fund. It's your financial safety net, not just a nice to have. 3. Diversify your income streams. Relying on a single source of income can be risky. Even if you've got a solid plan in place, life is unpredictable. Look for ways to diversify. This could mean having a side gig, investing in different asset classes, or even creating passive income streams. Consider Dave's strategy. Besides his rental income, he also invested in dividend-paying stocks. When one source wavered, the other kept him afloat. The goal is to ensure that if one income stream is compromised, the others can cover the gap. It's about not putting all your eggs in one basket. 4. Use fixed-rate loans when possible. Interest rate volatility can turn a manageable debt into a money pit. Fixed-rate loans provide predictability, which is crucial for planning. If you're taking on debt, shop around for fixed rates. I once advised a friend who was about to sign on for a variable rate loan. I told him, lock it in now, because the Fed might hike rates sooner than you think. That friend ended up saving thousands over the course of the loan, all because he chose certainty over the gamble of fluctuating rates. 5. Regularly reassess your financial situation. The market changes, your income changes, and sometimes your goals change. Make it a habit to review your financial strategy at least once a year. That means revisiting your debt levels, your emergency fund, and your overall investment portfolio. Ask yourself, is this debt still working for me? If the answer is no, it might be time to refinance, consolidate, or even pay off high-interest debts faster than planned. In one scenario, a client of mine found that by refinancing his home equity loan at a lower rate, he freed up additional cash flow, which he then redirected into paying off credit card debt. The numbers spoke for themselves. A monthly saving of over $200 that he reinvested, accelerating his journey to financial independence. Number 6. Plan for the worst-case scenario. It might sound grim, but if you don't plan for a downturn, you're setting yourself up for disaster. Stress test your financial plan. What if your primary income stops? What if your major investment takes a hit? Run through these scenarios and plan your response. I remember talking to a couple who, after crunching the numbers, realized they could barely make ends meet if one of them lost their job. They immediately adjusted their spending, built a more robust emergency fund, and diversified their income. These proactive measures meant that when they faced a job loss later on, they were prepared to handle it without resorting to emergency debt. 7. Seek professional advice when needed. Sometimes you're too close to your own situation to see the risks clearly. It might be time to consult with a financial advisor. This isn't about handing over your decision-making, but about getting a second pair of eyes on your strategy. Look for advisors who have experience working with individuals using debt as a leverage tool. They can help you fine-tune your risk management plan and ensure you're not missing any hidden pitfalls. 8. Be realistic about market cycles. Economic cycles are inevitable. When the market is booming, it's tempting to overextend. I once heard the story of an investor who, during an economic upturn, took on debt to double down on property investments. When the market reversed, he was left over-leveraged and scrambling to sell at a loss. Don't let the excitement of good times blind you to potential downturns. Always assume that the market will eventually correct itself. Plan your borrowing with conservative estimates, not best-case scenarios. As you absorb these strategies, remember that risk management isn't about eliminating risk entirely. It's about managing it intelligently. Debt is a tool, and like any tool, it's only as good as the hand that wields it. By knowing your numbers, building robust safety nets, diversifying your income, and planning for the worst, you not only protect yourself, but also position your wealth-building journey for long-term success. To wrap up, here's a quick recap. Track your finances with precision. Build an emergency fund that truly supports your lifestyle under stress. Diversify your income streams and opt for fixed-rate loans to maintain predictability. Reassess your situation regularly. Prepare for worst-case scenarios. Don't hesitate to seek expert advice, and always be mindful of market cycles. This isn't about being overly cautious. It's about being smart and realistic. I want you to leave this chapter with a clear vision. Every decision you make is a building block in your financial legacy. Risk is part of the game, but with the right strategies, you control it instead of letting it control you. Take these actionable tips to heart and remember, every small step you take now sets the stage for the financial freedom of your future generations. Now, go ahead, assess your current plan, identify one area to improve, and take the next step toward mitigating risk in your journey to multi-generational wealth. Chapter 6, Building a Legacy. Actionable Steps for Long-Term Success. When it comes to creating multi-generational wealth, you need to stop thinking in short-term fixes and start planning for what matters most, the legacy you leave behind. This isn't about flashy headlines or get-rich-quick schemes. It's about methodical, step-by-step actions that you and your family can rely on for decades to come. Let's get straight to the point. The first actionable step is setting up a solid estate plan. Most of us avoid talking about this because it feels grim or overly complicated. But if you want your wealth to benefit your children and grandchildren, you need a will, a living trust, and clear instructions for your assets. Consider the case of Mike, a 42-year-old father of 3. Mike wasn't wealthy by Wall Street standards. He had a modest home, a small business, and some retirement savings. But he took the time to create a trust. By doing so, he was able to avoid probate and reduce estate taxes, ensuring that 90% of his assets went directly to his family without unnecessary legal fees and delays. Mike's story is a reminder. Taking care of the legal side of wealth is just as important as accumulating it. Next, let's talk about actionable financial education. One of the biggest pain points for families is the fear that the next generation won't know how to handle money. This is why you need to invest in teaching your children about budgeting, investing, and even the basics of debt management. For example, Sarah, a single mother in her late 30s, started weekly money meetings with her 2 kids. She explained how she negotiated her mortgage, managed credit cards, and even discussed the occasional investment in a small rental property. By the time her children reached their teens, they were already savvy about managing money, a skill that's worth far more than any cash gift. This isn't a luxury, it's a necessity. Financial literacy is the cornerstone of sustaining and growing wealth across generations. Another key element is diversification. You might think, I've already invested in real estate. Isn't that enough? But history shows that putting all your eggs in one basket can be disastrous. Diversification isn't just a buzzword, it's a rule for survival. Take John, a 50-year-old who had built a comfortable nest egg in real estate. When the market took a downturn, he realized that without other income streams, his family's future was at risk. John rebalanced his portfolio by investing in dividend-paying stocks, bonds, and even a few small businesses. His income became more stable, and the risk was spread out. The lesson here is clear. Diversify your investments. Don't let one market dictate your family's financial security. Now, let's address the elephant in the room, debt. It sounds counterintuitive, but smart use of debt can actually fortify your wealth-building strategy. The key is using low-interest debt to invest in appreciating assets. Picture this. You take out a manageable loan at a low interest rate to purchase a rental property. The rental income covers the debt payments and then some. Over time, as property values increase, you build equity. I once met a family who did just this. They borrowed strategically to purchase a duplex in an up-and-coming neighborhood. With a down payment that was less than 20% of the purchase price, they managed to secure a property that not only paid for itself, but also provided extra cash flow. That cash flow was then reinvested into additional properties, compounding their wealth with each cycle. The numbers were simple, and the approach was pragmatic. Leverage debt, but do it wisely. Risk management is another pillar that you simply cannot ignore. It's one thing to build wealth, but quite another to protect it. Insurance, emergency funds, and proper legal structures are non-negotiable. Think of it this way. If your family's primary asset is a piece of property and a sudden illness or accident occurs, the financial blow can be devastating. That's why you should always have an emergency fund that covers at least 6 months of expenses and a robust insurance policy that includes life, health, and property coverage. Look at the case of Alex, who lost his job unexpectedly. Thanks to his emergency fund and insurance, his family didn't have to dip into their long-term savings. Instead, they were able to ride out the storm and get back on track. This proactive approach to risk management is a critical part of sustaining wealth for future generations. A legacy isn't just about money. It's about instilling values and systems that endure. One practical tip is to formalize family financial meetings. Yes, you heard that right. Set a regular schedule, quarterly or annually, where you review your family's financial status, discuss investments, and plan for upcoming expenses. In one family I know, these meetings became a ritual. They reviewed how much they saved, which investments performed well, and what adjustments were needed for the coming year. Not only did these meetings keep everyone on the same page, but they also fostered a sense of shared responsibility and ownership over the family's future. The actionable takeaway? Make family financial planning a regular habit. It doesn't have to be long, but consistency is key. Lastly, consider the importance of professional advice. It may seem like an extra expense, but having a trusted financial advisor or estate planning attorney can save you thousands in the long run. They can help you navigate complex tax codes, identify hidden fees, and ensure that your wealth transfer strategies are legally sound. Remember, it's not about handing over control. It's about making informed decisions that serve your family's best interests. So, here's the bottom line. Building a legacy isn't reserved for the ultra-wealthy or financial geniuses. It's a series of practical, straightforward steps that anyone can take. Start by getting your legal documents in order. Invest in educating your family about money. Diversify your investments. Leverage debt intelligently. Manage risk proactively. Hold regular family financial meetings. And don't shy away from professional help. These are not lofty ideals. They are concrete, actionable strategies that can transform your financial future. Each of these steps is a milestone. Whether it's the day you sign your first trust agreement, the moment you close on your first rental property, or the time you hold your inaugural family financial meeting, each action is a brick in the foundation of your legacy. And remember, the journey to multi-generational wealth is a marathon, not a sprint. It's built on consistent, disciplined choices made over a lifetime. As you move forward, keep your eyes on the long-term goal. Your decisions today are setting the stage for your children's success and your grandchildren's opportunities. This chapter isn't just about wealth. It's about empowerment. It's about taking control of your financial destiny and ensuring that your legacy is one of stability, growth, and opportunity for generations to come. Take a deep breath, roll up your sleeves, and start building your legacy, one step at a time. Chapter 7, Overcoming Common Pitfalls. When it comes to using debt to build wealth, mistakes can cost you dearly. And it's not just about interest rates or missed payments. It's about missteps that keep you chained to financial stress. Today, I want to break down real pitfalls and share actionable, straightforward advice to get you back on track. Let's talk about common mistakes and, more importantly, how you can avoid them. First off, one of the biggest pitfalls is over-leveraging. Many investors get excited about taking on too much debt in hopes of amplifying returns. But remember, debt is a double-edged sword. Take, for example, Mark's story. Mark, a 35-year-old contractor, once borrowed aggressively to flip homes. He took on loans that nearly doubled his investment capacity. But when the market slowed, his monthly payments started eating away at his cash flow. Instead of reinvesting, he was barely covering interest, and he eventually had to sell properties at a loss. Mark learned the hard way that knowing your debt-to-income ratio is critical. Actionable tip: always keep your total debt payments below 36% of your monthly income. If you're above that threshold, it's time to tighten your budget and consider consolidating or refinancing. Another common mistake is failing to understand the true cost of debt. It's easy to see a low interest rate and assume it's an open invitation to borrow more. However, small fees, compounding interest, and hidden costs can turn a good debt into a financial burden. Take Sarah, a single mom who once relied on a credit line to cover unexpected expenses. She didn't account for the compounding interest that quickly piled up, and within a year, she was $10,000 in the hole. The lesson here is to always read the fine print and use debt calculators to simulate different scenarios. Actionable tip: before taking on any loan, factor in all associated fees and calculate your effective interest rate over the loan term. Then there's the trap of debt neglect, ignoring your debt until it spirals out of control. Many people feel overwhelmed and choose to hope that things will improve instead of taking immediate action. I recall the story of John, a 42-year-old teacher who had let his student loans, car loans, and credit card balances accumulate without a plan. For years, he made just minimum payments, convinced that his growing income would eventually cover everything. But when a sudden job loss hit, his small savings couldn't cover the gap, and he found himself in a downward spiral. The key here is proactive management. Actionable tip: set up a dedicated debt tracker. Use a simple spreadsheet or a budgeting app to monitor every debt, set monthly reduction targets, and review your progress weekly. Treat it like a workout plan. Small, consistent actions lead to big results. Another pitfall is letting lifestyle inflation creep in. As income rises, many fall into the trap of spending more rather than saving or paying down debt. Remember Mark? Not only was he over-leveraged, but when his income increased, he upgraded his car and his home, leaving him with less disposable income to tackle his loans. This is where the pay-yourself-first philosophy comes in. Actionable tip: every time you get a raise or bonus, automatically allocate at least 20% of it towards debt repayment and savings before adjusting your lifestyle. This ensures that your net worth continues to grow even if your expenses do too. A critical mistake that's all too common is not negotiating with your creditors. Too often, people assume that the interest rate or payment schedule is set in stone. I once worked with a client, Lisa, who was struggling with multiple credit card debts. Instead of feeling trapped, she reached out to her credit card companies and successfully negotiated lower interest rates and more manageable payment plans. This simple step saved her hundreds of dollars a month and allowed her to pay off her debt faster. Actionable tip: call your lenders and ask for a review of your account. Mention competitive offers from other institutions if needed. It never hurts to ask, and the worst outcome is that nothing changes, while the best is a significant reduction in your debt burden. Now, let's talk about one more key area: the psychological pitfalls of debt. Many of us feel overwhelmed, anxious, or even ashamed when our debt levels rise. I want you to know that these feelings are common, but they shouldn't paralyze you. Take the example of Mike, a 38-year-old entrepreneur who once avoided checking his credit score for months because he feared what he'd see. His avoidance cost him both time and money, as he missed opportunities to refinance his loans at lower rates. Mike's turnaround began when he started viewing his debt as a challenge to overcome rather than a personal failing. Actionable tip: change your mindset. Set up a weekly money meeting with yourself where you review your debt, celebrate small victories like paying off one credit card balance or lowering your interest by negotiating with a lender, and adjust your strategy. This habit builds resilience and turns a source of stress into a tool for empowerment. I also want to emphasize the importance of an emergency fund. It might seem counterintuitive. Shouldn't you focus on paying down debt instead of saving? But lacking a financial cushion can force you into taking on more high-interest debt when emergencies strike. Consider Sarah's example again. Had she set aside even a small fund, she wouldn't have needed to rely on that expensive credit line. Actionable tip: aim to build an emergency fund equal to at least 1 month's worth of essential expenses. Start small if you must, but ensure that you're not forced to borrow more money when unexpected costs arise. Lastly, don't be afraid to seek professional help if you're in a deep hole. Sometimes, a debt management plan or credit counseling can provide the structure you need to get out of debt. I once recommended a debt management program to a client who was juggling multiple loans and feeling completely overwhelmed. With professional guidance, he was able to consolidate his debts at a lower overall interest rate and set a realistic payoff timeline. Actionable tip: if your debt feels unmanageable despite your best efforts, consult a certified financial advisor or a reputable credit counseling service. There's no shame in asking for help. Financial experts are there to guide you, not judge you. In summary, Overcoming the pitfalls of debt isn't about quick fixes or one-size-fits-all solutions. It's about taking deliberate, informed actions every day, knowing your numbers, controlling your spending, negotiating with creditors, building an emergency fund, and importantly, changing the way you think about debt. By making these strategic moves, you transform debt from a source of anxiety into a stepping stone toward long-term wealth. Remember, every small victory in managing your debt brings you closer to financial freedom. It might be a few extra dollars saved on a renegotiated loan, a monthly budget that finally balances, or the peace of mind that comes from knowing you have a safety net. These are the building blocks of a robust financial future, and they're well within your reach.